You know, with the cost of everything going up, many of us worry about the cost of borrowing and how what's happening now may affect current debt. Mike Giordano, financial advisor with Williams Wealth Management, is joining us this week to talk about that. Welcome, Mike. We're glad you're here.
Glad to be here, Carol. It's like taking us back to 2008, 2009 being back with you.
I know it. Borrowing costs on everything from cars to homes to credit cards has been going up. Is this something we should expect to continue?
Yeah, so let's take you back. You know, at the beginning of the year, the Fed had rates down to 0% from the beginning of the pandemic. They've already raised rates more than 2%, 2.25% to be exact, and now the market's basically pricing in that they're going to raise rates by another 0.75% here in a couple of weeks. So we're still going to look to see more rate hikes in the future. In a couple of weeks, we'll get a better guide map to what the Fed's thinking is. So you can expect interest rates to keep floating up. Mortgages, they were around 3% at the beginning of the year. Now they're closer to 6%.
Well, so if you're looking to buy a house, or if you're thinking, hey, this car's not going to last that much longer, I need to look into a new car, is this not the time to be looking?
No, if obviously you have to separate needs versus wants, but if you need something, you need something.
Yeah.
But the whole key is, if you're looking to buy a home or you're looking to buy a car, you need to finance it. Those are still good purchases to make. The whole thing you're trying to figure out is make sure you keep all of your debt payments within about a third of your overall income. So say you make $10,000 a month, you want to keep that to about $3,300.
Is this the time to get out all of your information from your credit cards and make sure that you're within range of what you want to be with your interest rates?
Yeah.
A lot of people aren't really sure what interest rates they pay.
Exactly. So you always want to look on your statement to see what your actual interest rate you're paying is. Credit cards, those float up as well. So as the Federal Reserve's hiking those short-term interest rates, it's also moving credit card interest rates up. Credit cards, it doesn't really matter what economic environment you're in. You really don't want to have any kind of credit card debt. So those are things you definitely want to trim as much as possible because, you know, the food you've already eaten, the car you already rented, the hotel room you already stayed in, you can't resell those things. So
yeah, well, that brings us to this point. What about if you do have a little bit of extra cash? Should you still be thinking about savings, or should you be throwing it all on those credit cards?
So, well, it depends. The whole thing about debt, it depends on what the debt is. Obviously, if it's credit cards, you want to pay off credit cards as much as possible, make as many extra payments as you can to wipe out credit card debt, because you're talking about that 16, 17, 18% interest. It's really hard to invest your money long term and get those kinds of rates of return. Conversely, if you got a 3% mortgage, look at the history of the market, you can do better than 3% investing your money in a a moderate way. So in that case, you can make those everyday payments. But again, this comes down to a general financial versus psychological. If you're psychologically averse to debt, making extra payments is not a bad thing. From a financial perspective, you're always looking at where interest rates are. So interest rates now in that 6-7% range, it's more of a toss-up.
Still have an emergency fund though? Try to sock away some money for...
Always important to have an emergency fund, because at any point something can happen and you want to make sure that you have that security. That's your base, that's your foundation. If you got a good emergency fund, you can start putting the other building blocks together.
Mike, thanks so much. A lot
Absolutely.
of good tips there. We really appreciate it.